I'd like to start with is taking a look at the current state and seeing how that compares to prior recessions. Just how bad might it be? Well, the first thing I think we're going to see is that 2022 is very different from 2008. 2008, we saw a 26% decline in home prices. And yet at the same time, I think it's pretty clear that we're likely to have a much greater fall than we saw in 1990, in which we saw a 2.2% decline overall. Now, we're already at 2.2% as of November 29th. I have no doubts that the December figure, when it comes out towards the end of the year, is going to show even further declines. So we've already crashed through 1990 and headed somewhere between 1990 and 2008. Now, how significant will the declines be? Well, how high will the Fed continue to hike? A lot of people, including me, thought that the Fed really isn't going to be able to raise rates terribly high. Why? Well, because of the size of the US debt. Last time they did this was in the late 70s and early 80s. Not sure if there are questions. Okay, just let me know, unmute if you got a question. So we were wrong. It looks like it's going to be a very high terminal endpoint. Who knows, maybe 5.25. Regardless, expect higher rates in the future, expect lower prices in the meantime. We should expect that this crisis will develop differently. What's different between now and 2008? Well, this time it's clearly not going to be driven by low home equity or poor lending standards. A lot of things have improved since the last time around. It shouldn't be amplified by a weak banking system. We have to remember that homeownership is determined by the cost of financing. The price, and I put that in quotes, the price of owning a home, that's not the price that you agree to pay. It's not the contract price. It's essentially your monthly payments. Let's see how the two recessions stack up. So in 2008, we had a huge oversupply. In 2022, we're significantly undersupplied. Home equity was very low last time and relatively high this time. We saw a pretty decent increase in the money supply both times. And we saw some decent inflation rates, topping out at 9% in 2022. Topping, I say, we don't know. We may not have seen the top yet. We assume that we've seen the top. Many people assume we've seen the top because we've seen lower values since. Mortgage rates declined significantly after 2008. Okay, I'd ask you all to mute if you could. It's hard for me to run the presentation and look for who's unmuted at the same time. So please, whoever is not muted, please mute. All right. And the price drop, yes, significant last time, over a quarter. This time, we still don't know. All right, let's take a look at how interest rates and home prices behaved. Now, again, last time we didn't see home prices responding to interest rates. In other words, this time we're seeing housing prices come down literally, not because we're in a terrible recession yet. We're seeing the declines as a result of financing costs. So in many ways, it's quite the opposite, but I still think it's quite instructive to see just how far prices fell and how quickly. So we topped out somewhere in 2006, and we didn't really hit bottom until around 2012. Interest rates declined moderately. Now, 1990, which I think might be a little bit more instructive because I think what we're going to see should be a little bit less severe. In 1990, we had a balanced supply of housing. Again, in 2022, undersupplied. Rather than reading the right column, which we've just seen a moment ago, I'll focus on the left column. So in 1990, again, we had high home equity. We had very small increase in money supply. It was a very mild recession. And inflation, again, did rear its head. Mortgage rates declined only slightly. And again, we saw only a slight price drop. And here's what it looked like in terms of home prices in red and 30-year fixed rate mortgage in blue. Okay, so how do things look in the present? Well, this slide was made about a month ago when we had only a 1.5% decline. And our interest rates, wow, just look at that. Nearly 4.5% increase. Unbelievable. Now we've pulled back a little bit from this in the meantime. But again, you look trough to peak, it's extraordinary. Expect it to increase further. I mentioned that home equity is better this time around. And here's our proof. What I find most fascinating about this graph is that if you'll notice, we actually saw home equity decline before prices decline. So here in gray, we've got the S&P Case-Shiller U.S. National Home Price Index. You notice that even as prices were leveling, owner's equity was declining significantly. It was declining significantly because people continued to use their homes as ATMs as long as they could. When people finally got underwater, that became impossible. All right, so I think that really brings us to the question of mortgage rates. Before we do that, though, any questions? Come on, don't be shy. All right, let me know. Don't be shy. Interrupt me if you like. But let's go into mortgage rates. I know everybody says mortgage rates are high, but how high is high, really? Let me go ahead a little bit. I mean, this is how high mortgage rates are. And by the way, every survey is going to be slightly different. Okay. Well, they were very high in the 70s and in the early 80s, even in the early 90s. Anybody who has been a homeowner for a couple of decades knows that, certainly we've seen higher rates than this. So why were mortgage rates, or maybe another way to look at it is, why were mortgage rates so artificially low for such a long time? Well, there's a lot that was going on there. First of all, in the inset, we have our federal funds rate. So notice that during the great financial crisis, we actually hit zero. So what can the Fed do? Well, once you hit zero, just about the only thing you can do is enter quantitative easing. And that would be the main chart here. If we look at mortgage-backed securities held on the Fed's balance sheet, you'll see they shot up right around the time we hit zero. And although we were easing off a little bit as we headed into 2020, the Fed decided to double down. And even in the present, although we say that we're in a tightening cycle, the balance sheet has not declined by much. What are the reasons for this? Well, the Fed wanted to decrease the spread between mortgage-backed securities, that is to say, the difference between your mortgage rate and the federal funds rate. So when you get down to zero, they thought, well, we want to keep mortgages even lower. We want to have this ownership society. We want everybody to own a home, the American dream. Well, we all know that we've had a few problems as a result of rates getting too low. We may now have two bubbles in housing from rates getting a little too low. Okay, so what is a normal mortgage rate, or where are we at currently? So this is, again, about a month ago, we topped out at about 7.08, and that is from the primary mortgage market survey from Freddie Mac. Now, if you look at this, the two blue shaded periods, we have relatively low rates. So what was going on in the meantime? Well, a lot of inflation. So this time the inset chart on the bottom is showing the federal funds rate. And that's what was done to combat all that inflation. Of course, the mortgage rates are going to sit essentially on top of that. And boom, right when we hit the peak in the federal funds rate, of course, no surprise, we see super high rates. All right. How fast are we actually increasing? Well, fastest so far. If you look at each of the rate cycles starting in the early 80s, this cycle has gone up further and faster than any. And again, this is even a couple months ago. We're going to go up probably a half a point and probably a half a point at least once or twice after that. One of the things I'd like to impress on you is that many people say, hey, I'm looking at the forward curve. I think that rates are coming down. Don't worry about it. Everything's going to be okay. Wait a second. Even if the Fed stopped hiking today, there's generally a bit of a plateau at the end. Before we go into that, how long do historical rate cycles last? So we got about 1.5 years for the first two, or the first two of the last four, and then 3.2 and 2.6 for the two more recent cycles. This is obviously significantly longer than we are into the current rate cycle. Now, again, you could say, well, we've hiked further and faster than we have ever before. Maybe this one will be a little quicker. But this is why I don't think that we should expect to see rates coming down anytime soon. Just take a look at how long the plateau is. So we have a range of between 5.1 and 14.6 months for an average of about 8.7 months. So what does this mean? Even if the Fed stopped hiking today, I don't expect that we're going to see rates start to come down for at least another, say, 8 months. That would be sometime in summer. And of course, nobody expects the hikes to stop soon. It's going to be a long time before we see rates normalize. All right, so now I want to ask the question, hey, I mentioned the forward curve. Just give you a very basic 101 primer on the forward curve. Are you curious to know what interest rates will be in a year? Well, you can consider that we have a current 2-year treasury at 4.39. You can also get a 52-week treasury bill currently at 4.98. So what is the inference? Well, suppose that you were going to buy a 52-week treasury bill today. 1 year from now, you buy another 52-week treasury bill. You would expect that you wouldn't want to do that if you could do better by simply buying the 2-year treasury note right now. So we'd have to believe that investors, being rational individuals, that you should be able to predict the 52-week T-bill 1 year from now. There's two issues with this. The first is that you do get a slight maturity premium for buying a longer maturity. And the second is that no one can predict the future, and any fool could tell you that. So let's take a look and see how good are these forward curves. Take a look at the 2016 case. So we were expecting in the dotted blue line that rates would sort of continue on as they had been, flatlined. What actually happened? Well, we see that the rates came down quite a bit. All right, so what happened, say, in 1999, 94, 1988? In every case, market expected rates to be flat, but the bottom fell out. And I can show you other similar examples. You can look at LIBOR. It's called the Harry chart for a reason. It's because these predictions that the forward curve makes are usually far too soon, and they don't go far enough. All right, so what does the US Treasury yield curve say now? It says, like, yes, well, rates should be coming down, say, within a year to two. Again, I would discount this heavily. What does the Treasury yield curve actually show us? It doesn't predict the future. It doesn't even tell us what's likely to happen. It does tell us, however, what the collective intelligence of investors says should happen in the future. So I do think it's worth paying attention to, but if we're going to come and take a look at this and say, hey, this is what's going to happen, or I'm going to base my future decisions on that, I don't know about that. All right, I think with that, let's end our section on the Fed and open it up again for questions. Questions, anybody? All right, we got a quiet crowd tonight. Very quiet. All right, let's take a quick look at factors impacting housing prices. So the first is the home price to median household income ratio. Now, you'll notice that this tends to range between about, say, 4 and 5. When was the last time that we got significantly outside the range of 5? Well, that was the housing bubble, also known as the global financial crisis, around 2006. Now, it seems that it's pretty clear that you can't really exceed this for long. Why? Well, because the free market works. If housing gets too expensive, you're going to see more people jumping into the building game, and eventually home prices will come down. The time before we saw prices far outside the range was in the 1950s. We're talking about the baby boom here. I want to say that markets are very irrational, and in the end, we can't have a home price to median income ratio of 8. That really can't persist. But we also know that we have a huge undersupply issue. That being the case, it's clear to me that we're going to have to see moderate price declines, certainly more moderate than last time around. Again, we were oversupplied last time. So what does it mean to be oversupplied? If you take a look at our stats going back in Fred from January 68 to July 2007, which was the last month that we were above the line, you see we have about 1.54 million completions per year, talking about housing unit completions. And here in this statistic, we're adding single family, adding duplexes, quads, all the way up to giant apartment complexes. So what do you notice? Well, before a recession, builders tend to be overly happy. They start building way too much, and then the recession comes and they get soaked. And this happens, turns out, time and time again. Probably most obviously during the Great Recession. We got above 2.2 million completions before the bottom fell out. What's different this time is the way that lending just dried up. And these builders, they weren't able to handle the loans that they'd made. They weren't selling the homes quickly enough. A lot of them went under. Now, if you add up all of the bars below the blue line, you see that we have about 8 million missing units since 2007. 8 million. Depends on who you ask. If you're looking at household formation, some people say 5 million. Well, we also know that a lot of millennials haven't ventured out on their own yet. We also know that we have lower household formation during recessions. Well, we just lived through a really big one. So I would say that these estimates of 5 million are probably a little bit on the low end. Also, we have more immigration these days. So whatever the country needed in the past, we certainly need more of it now. So even 8 million may be an underestimate. So again, housing undersupply doesn't mean that prices have to be supported. Why? Well, because rates have gone up so extraordinarily. Let me see. I wish that I had inserted a slide here to remind everybody that we got rates as low as, I believe, 2.65%. That caused prices to inflate in a very unnatural way. So now when you have rates above 6% and actually topping out at 7.08%, maybe around 6 weeks ago, boom, that is all it takes. Now, how do things look currently for residential construction? You'll notice that around the time of the pandemic, the leading indicators of permits and starts went way above 1.5 million. So the smart money would be on completions eventually going above 1.5 million. But what happened instead? Concerns about the economy caused builders to pull back significantly. And so it turns out we still haven't had over 1.5 million completions in the recent time frame, not since 2007. So with leading indicators returning to around 1.5 million, I'm going to say we're going to be undersupplied for a long time. Looks to me like it's just going to be the rates essentially jerking the prices around over the short to medium term. I'll be mighty surprised if builders start to build above 1.5 million anytime soon. recording this now around the middle of December. Now, another way to look at housing starts is per 1,000 households. You see, we're a larger country now than we were in the 1960s. So this is, again, further evidence that we may be even more underbuilt than we realize. One of the other interesting things about the pandemic is that this is where you really see a major increase in 2 and greater unit structures. So 2+ is in blue and 1 unit structures in red. The fact that we're even close to 1.5 million is because a lot of builders are switching over to multifamily construction. Okay, here's a chart of home equity. I showed you earlier that we had a lot more equity now than in the past. It's a little bit misleading because the housing values have also increased. And what I was supposed to do is actually have this normalized, but I did show you that chart a little earlier. So what I do want to say at this point, I think we've been over the main points here. We talked about the Fed, we've talked about mortgage rates, we've talked about the last 2 housing recessions, and we talked about several factors that support housing prices. What I really wanted to do, and it looks like we're going to do it just right on time, is save about half of the hour for questions. So now you guys were shy earlier on. I'm going to open it up now, and I am looking forward to having some questions from the audience.
Hey, George, my name is Moses Correa. Can you hear me?
Yes.
Cool. I'm an investor here in Chicago, and I had a quick question about something you said in the last slide or 2 slides ago about builders switching from single family construction to multifamily construction. What in your mind is the biggest, I guess, cause for that? Do you think it's a function of builders trying to be conservative and not trying to kind of bank on sales of single family construction with rates going the way they are, or do you think there are different drivers there?
I would say some of it is experience. One of the issues that we have right now is we have relatively young builders. I mean, this is a new generation of builders that is tasked with getting us back up to par. And I just think it takes a long time to get there. Also, I think that I'm certainly not the only one who's observing this housing crisis. And I think builders are saying, hey, we are relatively underbuilt. This is basically the only way to get there. We have a renter nation. That's another factor that I think has figured into to more multifamily structures. But anyway, I gather you've probably got some insights into that as well. Would you like to add on?
I actually don't. I was just curious. I guess in Chicago, I've seen both of that going on. There's a lot of new multifamily construction going on in my neighborhood in the Northwest side. But I've also seen a lot of single family homes. But obviously, Chicago's a very different market than the United States as a whole. So I was just curious if you had any insight into kind of more macro trends. But I guess that makes sense in terms of if you're trying to fill as big of a gap, it makes more sense to focus on multifamily construction versus single family, at least in the short term.
Yeah. Awesome. Thank you for your question. Any other questions? No? No other questions? All right. Yeah. Chad's got his hand up. Chad.
Pardon?
Oh, I saw you put your hand up. Question?
Oh, that's Chad. Yeah. Got to turn on his microphone.
All right. We'll give him a moment to turn on the microphone. And in the meantime, welcome Zasha all the way from Hawaii.
Hey, Zasha.
Aloha. Aloha, everybody. It's so early for me. It's only 3 o'clock. So
Yeah.
but I like your so I guess maybe we could discuss some of your strategies moving forward with multifamily, knowing that the rates are going up and things. I mean, these are common questions that we're getting consistently from our limited partners, and seeing now other projects needing to shift because they were, 3 to 5 years ago, who could have predicted, interest rates being this high? So I guess, how are you providing more security or a sense of kind of safety for your limited partners jumping into your newer projects, or maybe your existing projects that you're a couple years in and you're seeing now way higher interest rates? What are you kind of doing to mitigate the risks that, with the higher interest rates, I guess?
So the first thing I want is a price buffer. And if I can find a mom and pop deal where you have significantly under market rents, that's my price buffer. We know that we can raise those rents to market and that we should experience a good price bump. The second thing that I want to make sure that we're solid on the financing end. So I like seller financing. And again, mom and pops are really great at providing that. A lot of times they've owned for 10 or 20 years. They don't want to do a 1031 exchange. They just want to continue receiving funds every month without having to deal with tenants, termites, and tantrums, so to speak. And yeah, it really works out well, I would say, on both ends. So I like smaller deals for mom and pops with a lot of meat on the bone and seller financing. I think that's the best way to protect myself these days, until again we see the rates at least plateau or start to come down. I would throw one little note of caution that we don't know if we're going to have more than one bout of inflation. We sure did during the 1970s. So just because we see rates start to come down doesn't mean that they're going to stay down. If inflation kicks off again, who knows? So even when rates start to come down doesn't mean we're safe. Definitely a brave new world out there. But thank you for your question. But I feel like, Zasha, you're an experienced operator. So if you don't mind, can I turn the question around and ask you what you're doing?
I think the same like you. Moving forward, of course, we are looking at deals more conservatively, right? If the rates continue to go higher, what's some different exit strategies that we could use? And then the same thing is working with sellers to see, hey, can they finance the whole thing or finance a portion of it for however long? And then also just looking to the a few of deals that we've gotten into, or one deal specifically, we the general partners also own a construction company. So that's ways that you can hedge kind of costs if they can factor in directly dealing with the construction. Then that's the way you could just, because I know construction costs, eventually end up being more than we ever think they're going to be. And so that way they can mitigate some of it. But I think I'm the same way like you. I tell them, nothing is guaranteed, and, we're doing our best to kind of mitigate what's happening right now. But, the only thing we can do is run our numbers conservatively and get creative.
Yeah, and another thing that reminds me is tertiary markets and going into different markets. I mean, these low cap rate markets that were all in vogue yesterday, very dangerous today. Higher the cap rate I can get, the better, all things being equal. So loving some places that I might not have loved some time ago. I mean, I've been running away from the hot markets for a long time. I've been talking about places like Cincinnati and Eastern Tennessee, Kentucky. These are places I love. I may still own in Central Florida, but that's not a place that I'm looking to expand. I like the middle band of the country. It makes a whole lot more sense to me. And even some markets, and can't say anything yet, but even some markets that most people have never heard of, hopefully be able to announce a deal in one of those soon. Yeah, excellent question. And by the way, I just interviewed Pace Morby earlier today. So we were talking about strategies that are on their way in and strategies that are on their way out. Well, seller financing is definitely on the way in.
Yeah, we're working on a few other deals right now that we're acquiring that are trying to get the seller finance to be a part of it. Yeah, any creative strategies you can pull right now that will kind of lock in some sort of rate so you can, you know, kind of have some predictability would be the way to go.
Hey, guys, look, I have a question. Either one of you perhaps could answer for me. What are some of the things that would incentivize a seller to want to finance their own deal?
I would say taxes, tax purposes, you know, depending on how much they're going to make on the deal, that's what I've found that sellers are open to. If they don't need all the cash or not going to 1031 into some other project, and they're just a mom and pop, or maybe just you know, a single person or entity that isn't going to use it, then that'll definitely bump them up way higher in their tax bracket. So that's a reason why, is that they have a smaller income, but they can get, you can negotiate like the down payment so that they get paid like a big chunk. So it just depends on what they're looking for. But yeah, that's what I found in my experience doing seller finance deals, is that it's majority of the times it's tax purposes.
Okay.
Thanks for taking that, Sasha, from the audience. And I do think those are the top reasons. Yeah, not needing the money all at once, tax issues. And I've even heard some other strategies. I'm not your tax advisor, accountant, CPA or anything, but paying that money to a trust, which of course you are a beneficiary of as long as you live, and then essentially that being as good as a 1031. So that's something I'm definitely interested in looking into. One of these days, I'm going to be selling these things.
Well, then also you can offer a higher price if it's seller finance a
Mhm.
majority of the time as well.
Right. Because not only are you probably getting an under market rate, but it's also cheaper financing too. You don't need to get, for example, an appraisal and many other things. You can get your phase one. And if you aren't frightened by anything you see in that phase one, then forget the phase two, just move on.
Okay, thank you.
Yeah, no points up front. Gotta love it.
Well, and
But we'll-
the good thing, you just interviewed Pace Morby, so he's able to, it's crazy the things he can negotiate: 0% down, 0% interest, 50-year loans. Like, it's crazy.
Oh yeah, and my favorite trick from Pace is, rather than asking for a zero interest loan, say, can we have a principal only payments? I like that. It sounds better, doesn't it?
Mhm.
Yeah, great stuff. And another thing that I've heard about this seller financing is, and I believe this rings true, is that if you want to do one of these no money down deals, this is probably not the first or second deal you're going to do, right? You've got to be trusted to close, just like you have to be anywhere in commercial real estate. But again, once you build up your name, people know that you close and that you aren't just coming from left field. These things make even more sense. Yep, let's get creative. All right, awesome question. Any others? Or does everybody just want to have dinner? All right, I'm glad I'm getting some laughs. All right, well, hey, this is going out on YouTube, so this is your opportunity for commercial real estate superstardom. All right, how about this? We'll do the old going once, going twice, going three times. Any takers?
Hi, this is Sedu. I got a quick question. In terms of hearing about banks pulling back on lending in the commercial real estate, I've heard about that anecdotally. Do you have any specific information or data, or in terms of hearing about that? You know, would you say?
Well, actually, we have some lenders on the call, but speaking of banks pulling back, lenders pulling back, oh yeah, nobody's wanting to take a second these days. Gosh, I'd have to turn it over to Gary or Kenton. I mean, everything. It's getting rough out there, stormy seas.
Gary or Kenton?
I'm sorry, I missed the question, actually. Could you repeat it?
Um, oh yeah, just a quick question of like, people have said anecdotally that lenders have been pulling back. I just want to know if anybody has experience been going out to raise money to a lender in the past week, 2 weeks, month or so, and what your feedback has gotten, or what you're hearing out there in the world. If that's the case, or is
Okay.
that just the holiday season?
No, I think there's certain lenders, depending upon the region, where they're located, what their appetite is, meaning simply that there's some lenders whose portfolio are multifamily full. All right, so they've reached their allocation for that, so they're going to take a side to step off to the side and to wait and see where things are going. There's some lenders who, depending upon the developer, whether they're developing multi-tenant in terms of retail or single tenant retail versus residential type properties, then again, going back to my same premise, there are lenders who are taking a sideline. So absolutely, based upon some of the information that we got last quarter in terms of there's a possible another rate increase. If there's any lending going on, they're going to look more for a shorter period of time, 5-year versus 7-10-year debt. So, but again, it depends upon the region and the deal. I think to George's point, I too acquired an asset down in Kentucky. I like Kentucky. I like that area, and for some of the same reasons that you mentioned, George. And you can find some favorable lending in turn, as long as it's probably going to be a local lender, though. That's going to kind of like narrow that pool. It's going to be hard as heck to, if not impossible. I won't say impossible, but difficult as heck to get a national lender probably do a deal outside their local, outside their little sandbox, if you would. So hopefully that answers your question.
Yeah, great tips. So add some color to that. Lenders increasing the rates at the last minute, demanding another appraisal. These are things I've actually seen. Here's another thing. Let's take the agency perspective. Fannie Mae lets you float until you're closing, but Freddie will lock you at application. So what do you think everybody did when things got stormy? Well, everybody goes to Freddie. Now, can Freddie handle all that business? No, they're in the driver's seat now. So what do? They jack up the rates. And so it's not just me who thinks it'd be a great thing to lock my rates. Everybody else thinks the same thing too. So a lot of changes, a lot of differences. Kenton, I imagine you might have some color to share.
I'm sorry, I got distracted.
Oh, no worries. We're just talking about what's going on in the lending scene. Our lenders pulling back. Our lenders maybe don't want to rain on lenders. We love lenders. We need lenders. But
Well, it's much more than just
conservative?
getting more picky.
Yeah.
And that's really up to the GPs to make sure that they're the ones that get picked as it goes to get picked out. Okay, that means you need to look strong, have a good sponsor, have a large enough team so it looks like you can cover each other. In other words, there's some overlap all the way around the team. I also suggest adding advisors who are GP quality, who could step in if somebody needs to run off, get sick, gets hurt, whatever, so that you don't have a hole in your circle of GPs. So I guess the bottom line is that, the properties need to be stellar, probably, go up a step. But in terms of due diligence. But the second thing is you've got to make sure that the management team can manage and the management team can pivot. So if anything goes wrong, they either go up, around, or under and get the job done.
Yeah, good stuff. Thank you.
Makes sense to you, Gary?
Absolutely. Well, this environment allows you to cherry pick. We're in the business of writing safe and profitable business. And so at that end, it's good for lenders in terms of being able to do just that, being
Yeah.
to pick the best one. So yeah, the deal determines the terms, the way I like to look at it. You know, the better the deal, good deals sell themselves. So
Right.
the
Yeah.
stronger they are, the better.
And people aren't going to negotiate if you got a green team. That's for sure. And we're not talking about environmental.
Yeah.
Love it. Reminds me of the pumpkin plan. You got to stand out. If you don't stand out, no one's going to see you. But
You gotta
definitely
stand out.
time, there's a premium on experience.
Just you've got to think of yourself as going to a Fortune 500 company and being interviewed for a job.
Love it.
Can you face that kind of competition? Can you face that kind of in scrutiny? And if you can't, then you need to get some more people on your team that will. I mean, we all need energy. We all need action. We all need everybody needs to be used to doing at least some of the grunt work, driving out, taking pictures, going down in basements that may or may not smell so good, that kind of stuff. But, the point is you've got to look and act like an executive if you're going to be a manager.
I love it. I don't think we're going to top that. So maybe with that, we can end, unless there are any other questions. We'll do the going once, going twice, going 3 times.
Yeah, I think you've done a fine job. Thank you very much. Looking forward to reviewing the recording a couple of times.
Awesome. Thank you so much, Kenton, Gary, Moses, and Seju, I believe, are our question askers today, and Zasha, question asker and question answer. So thank you to everybody who showed up today. And hopefully we're going to have Sue next week or soon. Actually, don't let me promise next week. Soon we'll have Sue. And maybe we'll make a regular thing of this. I had fun. Hope you enjoyed yourself. Thank you.
I did it.
Thank you a lot, George. Thanks a lot.
All
Good
right.
night.
Thank you, Gary.
Bye, everyone.
Great information. Thanks, George.
Oh, hey, my pleasure, Kelly.